Good afternoon. Welcome. This is Webinar Wednesday. My name is Keith Brice. I'm the guest host for webinar number 251. Apologize if we have any technical difficulties. I haven't done this in a while. I think of the 251s that we've done, I think this is my fifth one, and you would expect me to have this down packed. With that, I'm going to start sharing my screen, and we have some exciting guests. I have Matt Starr and Anthony Olivieri and Coby Vance. We'll talk a little bit about their background, and they'll enlighten us about what's happening in the commercial real estate market. One of the things that's kind of cool in the fact that we've done these in the past, everybody wants to know, okay, what's going on with Kelly? Well, there's not a lot going on with Kelly other than the fact that he's celebrating the fact that both the Dodgers and the Padres are not in the World Series. Kelly's a diehard Giants fan, so he was able to point that out to me earlier. Want to do a quick breakdown of what we're going to cover today. The hot topics are going to be, we're going to have some World Series questions. We're going to want you to put your answers in the Q&A, and the winner will be announced after the World Series. Want to talk about interest rates. That's one of the hot topics of the day. And then finally, we're going to get into talking with our guests about the commercial real estate market. So let's talk about the World Series questions. Got 4 questions. The first one is, who will hit the most home runs for the Phillies? We have Bryce Harper, Kyle Schwarber, JT Realmuto, Rhys Hoskins, or none of the above. That's for the Phillies. For the Astros, who will hit the most home runs? Yordan Alvarez, Yuli Gurriel, Alex Bregman, and Kyle Tucker. Now, those Dodger fans out there, you cannot put in a what you really want to say about the Astros given the past, but please pick one of those. Give you a minute to look those over. Okay, the next 2 questions. Who will have the most wins? Justin Verlander, Framber Valdez, Zach Wheeler, or Aaron Nola? Those that have watched the pennant races, it was kind of cool. I think it was last week where you had Aaron Nola facing his brother. You had the one pitcher, Aaron's with the Phillies, against the I think he's a catcher for the Padres. I think he went 1 for 2. But that was kind of cool looking at the parents rooting on both players. And the last one is, who will have the most errors? I know you Dodger fans are rooting for Jose Altuve, Jeremy Pena, Gene Segura, Bryson Stott, or none of the above. So you had 4 questions. Go ahead, put your answers in the Q&A, and once the World Series is over, we will cover who the winner are and what the actual prize is to be announced. Want to talk a little bit about interest rates. One of the things that we get consistently here at Midstate is calls on rates. Where do you think rates are going? What's happening in the rate market? So we're going to spend a little time on talking about the different types of rates out there, different kind of products, and a lot of this is something that we take for granted and we know a little bit about. But this is going to give you a quick snapshot on what's going on. Keep in mind, all commercial loan quotes depend on several underwriting factors, including property, the borrower's location, loan to value, debt service coverage, property usage, whether it's investment or owner occupied, property type. You're going to see hotels, you're going to see hospitals, you're going to see office, fact, I think you're going to have both. I know Anthony will cover a little bit of the retail market. Matt's going to cover some office, and Coby will cover the industrial. But again, you're going to have different types of commercial rates for different types of properties sometimes. The interest rates on the next couple slides should be considered, again, indicative for properties in primary markets with good loan to values and good debt coverage ratios, as well as a strong and experienced borrower. Again, these rates are rates actually as of a couple days ago. So chances are these rates are changed and a little bit higher. Commercial loan interest rates can move quickly, as I just said. With so many small businesses are considering trying to stay on top of the most interest rates. It's hard to guess rates, by the way. I attempted that a few years ago and made some drastic investment decisions. They're always trying to get a good rate from their local lender, so they should shop around. We deal with a lot of the independent banks here in town and a lot of the national banks, and it's not uncommon for a lot of customers to shop rates a little bit. Additionally, it's useful for small business owners that are in the process of deciding whether or not to refinance commercial property they only own. So commercial rates currently are running between 5.25 and 17.33, and you'll see a little bit about how you get either one of those kind of rates, and that's depending on the loan product. For conventional commercial mortgages, the current rates are between 6.33 and about 9.25. Rates by loan type. Conventional rates go from about 6.33 to 9.25. Private banking, I'll give you some descriptions of what those types of loans are. 6.33 to 7.52. SBA 7A, you're looking at 5.25 and 8.75. And what we do here at Midstate, the 504, 5.32 to 6.46. That was a Freudian slip saying 4%. USDA product, 6.25 to 9.25. Insurance companies, I think Matt probably and Anthony has some experience with some of the insurance company financing. 6.25 to 8.34. Bridge financing, 8.33 to 17.33. Construction, 7.75 to 12.75. And mezzanine financing, 8.25 to 12.08. Again, that was as of a few days ago. Commercial rates by property type. As I mentioned before, you're going to get most of these, the floor, it's about 5.25, with the exception of hotels. They're priced a little higher. You have office, retail center, industrial, hospital, healthcare, self-storage, hotels, mixed use, and churches. See the top end about 17.33, and you'll get a flavor for what constitutes getting that type of rate. Commercial loans, again, they're loans offered by FDIC insured institutions, banks or credit unions. We have a lot of great banks in Kern County and in Bakersfield, and specifically, along with some really good credit unions. They typically require personal guarantees and underwriting of a global cash flow of the guarantors, including personal and business tax returns. This loan product can be used for investment or owner-occupied properties. And as you can see, you have a variety of terms. You got 3, 5, 7, 10, and 15. Fixed rates, you're looking at 7.02 all the way up to 9.25. Then you have floating rates. The max LTV starts at about 80% owner-occupied and 75% investor. And then you get amortization. Keep in mind there's a difference between a term and an amortization. A term is, you can have your payments amortized over 30 years, but the maturity of the loan could be as little as 3 years. Private banking mortgages. Private banking is provided to offer borrowers with high net worth and liquidity, preferred terms, and discounted interest rates. And in order to provide this service, the lender might request a depository or a private wealth management relationship with the borrower. They tend to have some pretty significant requirements of having additional monies with the private banking group. As you can see, the terms there, very similar, 3 to 15 years, very similar in amortization. The max loan value, maybe a little bit better, from 80 to 85%, and then 75% on the owner occupied in there. 504 loans, that's our sweet spot here at Mid-State. I've done a number of these programs to cover this product. We have 10, 20, and 25-year terms. Usually it's 90%, unless there's a special purpose aspect of it. You see the 10-year 5.325. We offer rates for both purchase and a refinance. And then you have your max loan value and the maximum amortization. 7A mortgages. In fact, we just referred out a 7A mortgage today. They're loan products that are guaranteed by the SBA, and they're used for owner. They can be used for owner-occupied real estate, machinery, equipment, inventory, FF&E, and working capital. Loan to value go up to typically 80% and may be used for construction and existing properties. Terms, 10 years. Again, we're talking about mortgage rates. Fixed rates from 5.25 to 8.25. Floating, not necessarily available for the 10-year product. 85% owner occupied max, amortization 25 years. USDA mortgage rates. We do have a pretty strong USDA office here in Kern County and throughout California. USDA loans may be used for acquisition or construction of commercial real estate, purchase of machinery, equipment, or establishment of working capital. The kicker, though, is typically only available in certain rural areas with populations of 50,000 or less. So you may not be able to get a USDA loan here in Bakersfield, but you perhaps get one in Shafter or Wasco or one of the surrounding cities that meet that population level. They are floating rates, fixed rates. They're typically priced on a per transaction basis. That's PTB. Owner occupied 80% or investment, 30-year amortization. You have 7-year terms, 10-year terms, and 30-year terms there. Commercial insurance rates, typically the most conservative and competitive of all the products. Most insurance lenders prefer newer, high-quality properties at low leverage in major markets and very experienced investors. There are insurance companies that have lent into this market here. I'm pretty sure the commercial brokers that I have as guests today have had some experience with some of the commercial lenders utilizing life insurance companies. Their terms, as you can see, 5, 7, 10, and 20 to 30. You can see where the fixed rate market is. Floating is typically not available. Max LTV 70%. Again, it's most of these insurance will look on a per project basis, so that LTV may not be as high depending on the product type. Bridge loans. We have some lenders that are in the bridge loan area here. They're used for light renovations or restabilizations of investment property. These are typically higher interest rates on loans and are used short terms, 6 to 36 months, till the property is fully renovated or restabilized. Prime example is you have a shopping center that's changed owners and needs some money into it via a bridge loan to do some some improvement, shore up the tenants. We used to call them mini loan, bridge loans, get it stabilized, and then they will seek out other lower interest type of financing out in the market. Again, 6 months to 36 months. And as you can see, the rates are in the high end, recognizing that this product is typically just a transitional type of loan. There's truly not an amortization. It's mainly interest only. Construction commercial loan rates, they're used primarily for rehab, redevelopment, or even ground up construction. Interest rates can range depending on the lender, property type, and the market loan product. Almost all of the construction loan rates are of the floating nature, 6 months, 12 months, 24 months. You know, when you get into a 36-month construction loan, that's typically a little longer development type of product, or they may have a stabilization component to it. In other words, you have a apartment under a construction loan, and until they hit certain occupancy numbers, it will stay into that construction loan period and then flip over into a term loan. Mezzanine financing, this is a hybrid security of debt, equity put into property in a second lien position. Typically, it's behind a senior secured lien. When the borrower's loan to value on the overall product is not high enough to specifically finance a piece of commercial real estate, it can be also be used for the acquisition or refinance of investment property. Again, mezzanine financing, 5, 7, 10 years. Loan to values about 75%, because again, they're in a secondary lien position. And then you have hard money loans out there. We have a few hard money lenders in our Kern County market. They're typically loans offered by private investment institutions or companies for financing non-bankable properties, credit issues, property issues, short-term close, any number of reasons why hard money lenders are utilized. Rates are extremely high, typically in the 12% range today. They have been lower, they've been higher. We don't necessarily recommend this product, but we have financed several properties under a refinance of a hard money loan, whether it was a quick close to retain the property or some other reason why they had to go the hard money route. So just a little flavor of the different types of loans. I think I want to show you, we always get the call, what's the difference between your residential and commercial rates? Obviously you always hear where residential rates are. That's more probably most people get home loans. And typically it's because residential properties, and this is 4 units less, usually have lower interest rates because of commercial properties. Additionally, the terms and amortizations typically match a residential loan. It's 30 years, whereas commercial loans, as I showed in previous slides, you may have an amortization at 25 years, but you may have a maturity in 7. So that's one of the reasons why the rates are a little bit different. Yeah, we also get questions on how our interest rates calculated, and I know in the commercial end, interest rates are calculated in a variety of ways depending on the lender's internal cost of funds. And the most common way a lender calculates an interest rate is by taking an index, whether it's LIBOR, Treasury, swaps, FHLM, or any type of index, and then they have a spread. The spread is where they make the money. So if you look at a LIBOR type of pricing, let's say LIBOR's at 3.56 plus 2, your interest rate would be the 5.76, and that spread is where the money is made for the lender. Different market index rates. You have prime, you have 30-day LIBOR, 90-day LIBOR, 6-month LIBOR, all the swaps, the 504 pricing, we talked about 10, 20, 25, and then we have 504 refinancing pricing. So just wanted to give you a snapshot of rates and the different rate components, and the fact that had I done this same presentation 3 months ago, rates that we're talking were probably 250 basis points. That's 2.5% lower. And these rates that I'm talking about today, our chances are they're going to change next week. So get a feel for if you're looking for rates and looking for different indexes to track it. You can find information online. Old school used to get it in the Wall Street Journal, but most of the stuff is driven by current data, which is shared online. So with that, I want to bring in my guest, and we're gonna focus on commercial real estate, office, retail, and industrial. With that, Maureen, I want to open up the mics of both Matt, Coby, and Anthony.
Let's just have all of them unmute.
Well, they'll unmute at this time.
And then Anthony, there we go. Great.
I'm gonna start with Matt, and I'm gonna read his bio, and I'm not gonna attempt to read all these guys' bios because, as you can see, it's quite impressive. But Matt's principal with ASU Commercial. Matt serves as principal of the Office and Services Group, specializes in landlord and tenant representation, as well as buyer and seller representation and investment and owner user transactions. He is responsible for coordinating the landlord leasing services, seller disposition, and strategic space procurement. I'll say that a lot of times. That's a mouthful there, Matt. I'm gonna jump down to some of the highlights. Matt's been in 19 years. He's totaled over 560 million in consideration, and the other impressive thing is 3 million square feet of office space. He's active in the community, Society of Industrial Office Realtors, certified commercial investment member, Greater Bakersfield Chamber of Commerce, the Bakersfield Association of Realtors, St. Francis Parish School Finance Committee. One thing that folks out at CSUB are proud that he's a proud CSUB grad. One positive is I think Matt and I are one of the few Pittsburgh Steeler fans that are on this webinar here. But thank you, Matt, for participating.
Thanks, Keith. Is that a positive or is that a negative right now?
Well, it depends on how they do in the next few weeks. Next is Anthony Olivieri. Anthony's the president of the Olivieri Commercial Group. Anthony has over 35 years experience, commercial real estate experience in leasing and sales development. He has worked with countless clients covering a broad spectrum of products, both geographically and various market segments. Based on the diverse background of knowledge in the field, he offers a unique skill set. Again, I'm going to skip over a lot of this stuff because Anthony, and I shouldn't, because Anthony's technically my boss. He's on the board of Mid-State Development. He was former board member of the Kern Real Estate Foundation and Goodwill. He's very active in the community, and Anthony is the proud grandfather of now 3 grandkids. Is that not correct, Anthony?
That's right.
Okay. And last but not least, I have Coby Vance. Coby is a senior director with Cushman and Wakefield. Coby specializes in industrial real estate brokerage in the Greater Bakersfield and Central Valley. Coby, along with his business partners, Wayne Kress, Scott Reynolds, and Nika Cabela, make up the Golden Empire industrial team, servicing sales, leasing, and valuation needs of their clients, both large and small. It's kind of cool. Coby joined Cushman and Wakefield in 2004. Coby was a mid-state intern, and we are very proud of the fact that he is one of the top industrial brokers in the community. They handle a lot of large projects, including Calcium Cook, Lufkin, Weatherford, County of Kern, Shafter, and a number of companies out there. he'll tell you a little bit more about himself. And Coby is a diehard Ohio State Buckeye fan, and I think he's a closet 49ers fan, but we'll talk about that maybe a little later on. So welcome, guys. I appreciate you participating. And for that, we're gonna start with the first question. I think a lot of this may have been handled in your bio, but if you guys take a minute to answer this, what geographic locations do you specialize in?
We want to just go down the list.
Yeah, we'll start with you, Matt.
Primarily Kern County, Keith. ASU Commercial kind of covers the entire Central California region. But my specialty within the office world is mostly Kern County, at least as it relates to my office transactions. I do venture outside of Kern County, outside of California, in some examples, representing buyers of investment properties, primarily in 1031 exchange transactions.
Coby.
Kern County as well. Although we will venture up north, we've done, especially in up in the Central Valley with larger industrial projects up in the Visalia market. Cushman and Wakefield has a Fresno office, so if it gets that far, obviously our Fresno team handles that. But we'll go. We've done several in the Visalia, Tulare market, but mainly Kern County is where we specialize.
Good. So I think, again, you touch a little bit on this in your bios, but I like to get a little bit more specific. What kind of businesses do you guys usually represent? And I'll let you go first, Coby.
Well, it runs the gamut. Small businesses that, looking for, we go anywhere from startups that are looking for, 2,000 to 4,000 foot units. All the way up to us representing Amazon on large fulfillment centers. So it kind of spans the gamut of what's out there. In terms of the type of tenants has changed over the years. When I first started in the industry, I'd say over 50% of every deal we did was oil field service type related, and now that's probably less than 10%. And it's really morphed into a logistics, distribution, in that trucking, in those type of products that we work on a lot now.
So I want to stay on that for just a second. So would a prime example be, you sold a 10,000 square foot or leased a 10,000 square foot warehouse 8 years ago to this service guy in the oil patch, and now who's looking at that building?
Well, it's changed in terms of the type of industries. I mean, as a really good example, it's we had a solar company, some sort of renewables company. We've done deals with companies that are in the business of in the oil field service, whether that be they're working on decommissioning deals where they're more in the environmental game. I mean, there are still oil field service type needs out there, but it's much smaller in terms of who's looking in that industry. And so you really are changing the terms of when the last legislation passed with they called it the Inflation Reduction Act, but really was the Green New Deal, if you will. A lot of solar, a lot of new solar leads and companies that are looking in our market or that are expanding into the market, as an example. Okay.
Matt, what kind of businesses do you usually represent?
Really all across the board, any user that needs office space. So whether that's, oil and energy, which is, like Coby said, becoming less prominent in the local market, accountants, attorneys, nonprofit agencies, government services, medical, physicians, banks, engineers. So really all across the board from an office standpoint. And then on the flip side, represent owners of real estate, so investors and speculators, developers who are taking developments from ground up to finished product. So really all across the board.
Anthony.
Yeah, we're kind of the same, Keith. Here at OCG, we cover representation of national companies, regional as well as local. And predominantly, it's in the retail sector, though we do cross over into the office market and industrial to some degree. And like Matt had mentioned, we spend a great deal of time in the investment side. One of the things that we kind of pride ourselves on is having the capacity to take somebody from a concept of a piece of dirt to fulfillment of a project that's gone vertical, and helping them through every step of that phase, because those are projects that we've completed internally within our own company. And so we offer kind of a unique piece of experience with doing that.
Good information. We get this a lot here in the type of clients that we deal with, but so what should a buyer expect when they purchase commercial property for the first time? And I want to take a little bit of this in that it's a sticker shock when they go from having a $450 appraisal to a $4,000 appraisal. That's just one little piece in my world. But with that, Matt, I'm gonna have you take that first.
Yeah, that's a good point right there, just on the appraisal side. Well, getting a loan on commercial property is a lot different than residential. In some ways, it's probably easier, but other ways, it's more different. And what I tell a client is just do your pre-work to make sure you've had conversations with a qualified commercial lender, that you investigate your capabilities in terms of how much equity you're able to put into a deal, what your costs of your monthly exposure is going to be, essentially getting a little bit of pre-work done on the underwriting, so that you understand what you can buy. And then it's also a good idea when you're going into a commercial loan to have a good qualified team, not only a broker that's representing you, but a good transactional attorney, a good CPA to advise you on tax implications of a purchase. And if you can have a construction and an architectural relationship, pretty helpful as well, because oftentimes people coming in to buy commercial property, they have to make modifications to suit the needs of their particular business. So there's a big team that goes into that process.
Anthony, you want to add something?
Yeah, I think Matt really hit kind of the key points. My thought to go along with that is, just have a solid team that you build, and making sure everybody has the capacity to contribute and to add to the team. Another, I think, important component is understanding the true cost, and doing a kind of a cost benefit analysis, and understanding at the end of the day, from a year to year standpoint, is what does the ownership cost you or potentially save you in your operation and in your own personal asset base. So those are some things that I think first time or buyers should kind of expect when looking at the development of something for the first time.
Coby, anything to add?
Well, they touched on a lot of it. One of the things that I would add is, especially if someone's new to it, is the time, how long it takes to get everything done. You mentioned the cost of the appraisal. I mean, the time of the appraisal isn't, you go from 3 days for a residential appraisal to, upwards of 3 to 4 weeks on a commercial appraisal. And then you have other things that are going to be required you don't have in the residential game, whether it be an environmental report, all the different, liens on the property, or any of the easements on the property. Just a lot more involved with it in terms of what you need to be aware of. So like Matt and Anthony mentioned, having a good team in place to make sure that they're advising you and making sure you're looking out for the right thing. That's really for us. And then on the industrial side, just specific to us, is the lack of product. I mean, people think, if they're, you can look at 20 different houses, in your size range or whatever, there may be 1 or 2 buildings to look at. So you really have to, understand that the market and, what your needs are when you're looking at it.
One of the things I want to add to that is one of the areas that always makes us nervous at Midstate is we'll get a client that comes in and they're being represented by a residential broker. And I would say this, if you guys were not on the webinar, we always, we got to be respectful of their relationship with that residential broker, but we always try to have them strengthen their team by dealing with a commercial broker. There's just so many different little nuances in a commercial transaction that again, no knock against a resident. There's some great residential brokers out there, but their sweet spot is not commercial. Their ability to get a commission may be driving that, but we always strongly encourage them to get a commercial broker. And the other piece that Matt touched on right at the beginning is dealing with a qualified commercial lender. That's important. I know you three have several relationships with commercial lenders that understand commercial real estate lending. So that's a difference between an order taker lender and a commercial lender. So I like to hear the fact that Matt is encouraging borrowers out there to make sure you have that part of your team. Something that's always interesting that we don't do a lot of, but I wonder what your take is what's the process that you guys use to determine is purchasing better than leasing? Now, a lot of that's part of the customer's input, but what are you guys doing? And Anthony, I'm going to start with you.
Yeah, thanks, Keith. So one of the things that I try to do is get an understanding of the business and the business owner's perspective of kind of where they are in it from a maturity standpoint. Are they looking to grow considerably, or maybe there's a retraction component to their business coming up? Because if one of those two exists, buying a piece of property may not be the best option for them in the short term. So having some stability and being able to forecast where they are is important in terms of what their needs are. Another piece that I look at and a question I ask them is, can they gain a higher ROI on investing the same money that they would put into a piece of real estate back into their business? So for instance, if their ROI on the widget that they manufacture or sell is 25% annually, are they better off putting that capital back into the business and building off of that versus putting it into a piece of real estate that may only appreciate 2 or 3% a year? There's other factors that go into it, of course, but those are questions I like to ask and at least get that thought process started and put it on the table.
Coby, anything you want to add to that?
Yeah, no, I think that's a big component of what Anthony just mentioned. I mean, I let local, a lot of the buyers are local in nature. Large companies, just like Anthony said, they get a better ROI on their business. And so large companies like the lease because they, get a better return on the business than they do real estate. So, it's really it's more of a local, generally speaking, local flavor. So it's, is your business stable? Do you think what you need for the next 10 years? Do you know what the building requirements are going to be? Where are you personally? Most businesses, you probably know this, Keith, they buy it personally, they lease it to their business. So it's more of a personal asset growth build rather than the business return that they're looking at. They're looking at their personal balance sheet. So it's really just a question of, where they stand in their business and where they stand personally with liquidity. And is their business stable, that they don't need to use that personal liquidity to make sure their business continues to operate.
Matt, I know you see a lot of office lease requests. What do you do anything in addition to what was mentioned earlier?
Yeah, these guys pretty much nailed it on the head. It's a matter of looking at the cost of occupancy, and there's been a pretty broad trend towards ownership over the last decade here, at least in the local market. And it's a function of the interest rate environment. But one, do you have the capital? available to invest into the real estate, and what does that make your occupancy costs look like when compared to leasing space? So those are simple calculations we do once we understand the liquidity of the buyer. And then, to Anthony's point, it's a matter of how much flexibility an occupant needs or a business needs. If you're growing, if you're starting out, leasing makes more sense. There's definitely a lot more flexibility you can have by leasing space, either on a short-term basis or going into a larger building that allows you to move up in space sizes or expand into contiguous spaces. But if you're a well-established business and you have the capital available, oftentimes purchasing will be the right choice. But I think we're going to see that change here over the next couple of years as we're coming into a higher interest rate environment. And to date, we'll touch, I think, Keith, you're planning on touching on this a little bit, but it depends on where lease rates are.
Right.
Retail might be a little bit different than office, but we've had some relatively level lease rates within the office world. So I think you're going to see a little bit of a switch back to tenants preferring the lease over the near term.
Yeah, I know, a 200 basis point jump in rates in the last 3 months will make some changes within the marketplace.
Yeah.
Speaking of which, where is the local market right now for tenant improvement allowances and any rent abatements out there? Coby?
Well, on the industrial side, there's not, the landlords are in the driver's seat on the industrial side, and we're less than 2% overall vacancy rates. And since the pandemic, since the immediate lull, March and April in 2020, it's been nothing but, up for us. So in terms of rent abatement, it almost is non-existent outside of large companies for long-term deals. But for the smaller local stuff, it's, the rates are as high as they've ever been, and allowances are slim to none right now.
Matt, what about in the office market?
Yeah, I'll just say in general, the cost of the construction is a big headwind in the office world. And office properties are a little bit different from some of the other segments of commercial real estate in that investors and property owners on the office side have a more regular ongoing commitment to contributing tenant improvement allowances towards retrofitting space in older buildings and even on the new construction side as well. And we've really seen a significant increase in the cost of construction. It hasn't necessarily resulted in landlords contributing more. In some cases it has, and it really depends on the submarket and the particular vacancy rates within those submarkets. But I touched on it during the last question a little bit, that lease rates have not increased to the level that construction costs have. So right now there's a bit of a struggle for landlords to justify increasing their TI allowances because their rates aren't going up. And there's a bit of a gap between the construction costs and TI allowance environment that depending upon the deal, depending upon the size of the lease, the creditworthiness of the tenant, and the submarket, like I say, there's some challenges in closing those gaps between what a landlord's willing to provide and what's required to get the lease completed and retrofit a space.
Anthony, you see anything out there in the market in your area?
A lot the same. I think that what Matt and Coby touched on, we're finding that in the retail side as well. A lot of it depends on geographically within the local community, and the product type that's being leased. You'll see different incentives being offered. So for instance, in some cases, we'll see the rental rates for existing second generation space has increased somewhat in the last couple of years. But we've seen a very stable market too. So, it's been able to kind of justify that increase because of lack of supply. But I think that that's changing a little bit. We're seeing in some cases, again, some supply coming back onto the market. But, and then we have these kind of anomalies of like the restaurant sector, and a lot of restaurants are doing really well, continue to do well through COVID. The ones that have maintained operations and been in business, and those that have drive-throughs have done exceptionally well. Still a lot of growth, a lot of interest in expansion there, and product virtually unavailable in the marketplace right now to try to find existing restaurant space with a drive-through that or is available for lease on second gen space. So pretty tight market. Incentives really haven't shown up yet. We'll see what's in store for 23. But yeah, that's kind of on the retail side.
Anthony, I think you kind of answered my next question, and that was where is California in the national market trending right now? So I think it sounds like is it treading water? Is it trending up? What do you see?
On the retail side, Keith, on some of the national tenants that we're dealing with right now, there's still stronger interest in the market to grow, to add more units. A lot of them are seeing very, very strong sales growth in the local market. So they haven't really shied away from adding more space to our trade area. There's been some resistance in negotiating the new rent structure, as kind of Matt alluded to, that we're seeing construction costs go up substantially across the board. And so we know that a ground up project, what we budgeted, say in 21 is not going to work in 23. And so it's been interesting seeing the pushback a little bit there, but also the acceptance as well. So we're seeing tenants willing to renegotiate, understanding that they've got to be at a new baseline for rents to be in a market. So we're seeing growth, we're seeing interest, but I think it's cautious. I think people are kind of cautiously optimistic that things are going to be okay moving into 23. But so I think we're doing better than treading water, but I think that we're not doing substantially better right now. There's a lot of discussion, a lot of interest, but we'll see if that turns into fulfillment of deals.
Coby, on the industrial side, where are you seeing the California national market trends?
Well, California in relation to the U.S., California is always a headwind. It's just difficult to do business here. But in terms of how that's manifesting yet, in terms of our demand and our rates, it hasn't. There's just such a lack of supply in the industrial market, really throughout the U.S., but California as well, that even, if demand wanes, it doesn't matter. There's such a lack of supply that we're, landlords, everything's trending on their side for what they, for what they can ask. But the real big problem that is going to really affect us, we're starting to see it, but it's really going to get bad, is going to be power. It takes so long to do any construction project in general. Whether it be you have to do an environmental impact report, which is going to take 12 to 18 months at best before you can get it rezoned, and then you can build a building. And there's such a lack of supply of buildable land that's ready to go, that is through the CEQA and all the different environmental regulations that California implements. You look at Bakersfield, you look around, you look at nothing but land. All of which is 3 years away from even, starting to turn dirt. That's a real big problem. And any construction projects that are going, our horrible power grid is really causing a lot of problems. We just don't have, it's not necessarily a generation a power problem, it's the grid problem. They simply can't sustain any of these of some of these larger buildings. As an example, there's a 1 million square foot building being built right now and out in Shafter, and they're having to pay for or supply it with electrical power with a gas turbine generator that is really expensive, but they can't get a commitment for power from PG&E for at a minimum 2 years at best. And that's going to be a real big problem, because that basically continues to shrink the supply. And you couple that on with where interest rate environments are and all the regulations that California gives you, there's, even if demand, goes down, there's such a lack of supply here, and there's still such a need. We have 40 million people. I just don't see it. I see it being a real big problem, the supply. I don't see the problem with demand, if you will.
Well, one thing I want to add is we have, like you, your Shafter example, we have a real life example here where we have a construction, we're the takeout lender, but we have a project that's under construction, and they're coming pretty close to the maturity date of our loan authorization. And they have a request to do an extension, and they asked for a year. And the reason why they needed a year is because of the utility.
Yep.
And it's going to be interesting because typically we ask for an extension for a few months, but your example, and this is another prime example of not being able to get the utility service. So
Well, you're going to see a lot more of that too. I mean, I literally just came from my personal project this morning in switchgear. I mean, we ordered a switchgear in March. It's supposed to be delivered in August, and now they think maybe in March of 23.
Yeah,
and so we're dead in the water. We have to get the switchgear green stickered before we can even get on a PG&E construction schedule. I mean, if that is true, I mean, we're working on that. But that's happening all over California. That's, I don't know if it's a nationwide problem, but it's a real big problem here. And I don't know how that gets solved.
yeah, and from a lender's perspective, the tide put a sort of a bow on that. As a term takeout lender, we cannot fund until the project's completed. So if you remember the screen that I showed on the construction loan and the construction loan rates, those borrowers, if they're borrowing, are stuck in that construction loan period that may or may not be required to have renewals and fees. Matt, anything you want to add about the trend in California and nationwide?
Yeah, office is a little bit different, I think, than both retail and industrial. Everybody heard that the chatter after COVID that the office space is dead. Everybody can work from home. I don't see it that way necessarily, and I don't think the world sees it that way anymore. In some parts of California, some larger markets, and outside of California, I think you do see more of that on an ongoing basis, and I think that's due to a couple of things. Their cost of occupancy is a lot higher than it is in Bakersfield. The rental rates are higher. You've got long commutes in some major markets, so mixing in this work from home environment as a long-term solution to business is more realistic. But what we are seeing here in Bakersfield is the implementation of hybrid work environments. So where you have companies that, whether they're national or regional or local, they have a mix of, you're in the office certain days of the week, you're working from home because it's proven to be effective. Maybe not on a permanent basis, but as a share of the work week. And so what it's allowing companies to do is reduce their footprint, becoming a little bit more lean and reducing, in effect, their overall occupancy costs. So I think that's going to affect kind of the long-term situation with office space. I don't think office is dead by any means. And then I'll just bring this up, which we've already touched on, kind of the decreasing dependence on oil and gas, or the decreasing activity we've seen with regard to primarily industrial and office space. That's a real thing here in Kern County. So where, oil and energy users used to be the driver of our office market, they no longer are. I mean, they still, whether it's the production companies or the service companies, they still represent a large component of office space, but they are not driving new construction. We are becoming a more diverse local economy, which is good, but we don't have one market pushing us forward. And that's one reason why I don't think we've seen a substantial amount of office development. Other than owner user occupancy development, there hasn't been any large scale multi-tenant new construction in Bakersfield for quite a while now.
I'm gonna jump to a question. I had the last question, but I think I want people to hear what your thoughts are, and I'll start with Matt. Bakersfield area. where are you going to see the most growth within the next 10 years? Where do you see it? In let's say in the office market there.
I continue to expect to see it out on the west side of town, whether that's, northwest submarket, which is a smaller submarket. It's more of a suburban garden office submarket. But primarily within what we call the University Center submarket. So west of Gosford and Coffee and south of the Kern River, really everything surrounding Cal State Bakersfield, and even a little further southwest in the Seven Oaks Business Park. And that's where, we started tracking that submarket as its own submarket back in 1999, 2000. And it's always been our lowest vacancy rate market, highest rental rate market. And it's really driven by business owners wanting to office in a certain demographic where a lot of their white collar workers live. And really it's where the quality new construction has been. So when we see office users, I talked a little bit about rental rates having to increase due to the construction costs. Well, in order to pay higher rates, these tenants are focusing on higher quality properties too. So that's where the higher quality properties are. There's still plenty of quality properties in the California Avenue corridor and downtown, but there's been a real push to get into the newer, nicer office space. If you're going to be forced to pay higher rents that new construction, requires, that's where they want to be. So I think we'll continue to see it out on the west side of town. I do have some hope that, it'll turn in the other submarkets as well. I'm hoping that downtown Bakersfield has a resurgent office market, but to date, it really hasn't. The quality hasn't been there. Our vacancy rates have not been quite low enough to stimulate the redevelopment of some downtown buildings, but it could be on the horizon with the lack of new construction.
Anthony, I think every buildable corner in Bakersfield has a C-store, a Starbucks, and a nail salon going in. So I will ask you the question, what areas do you see is going the most growth within the next 10 years?
So it's interesting, Keith, right now, there are large retail developments, and I say large in scope, probably the size of 25 to 50 plus acre projects planned in consideration in every sector of the market or every quadrant of the market. So the Northwest has 2, the Northeast has 1, Southeast has 1, and the Southwest has at least 1. And so, we're seeing kind of the growth and the activity in the retail side being dispersed, pretty evenly throughout the community. And the reason for that is that we've seen pretty consistent growth in all of those quadrants for the last 3-4 years. I mean, you just see new rooftops kind of going up in every quadrant. So that justifies the need for more retail. So those are large scale projects that, take years to actually come to fruition and people to be able to shop there, but they're in the works. And so, barring any significant recession or downturn in 23, we'll probably see those happening in being completed in 24 sometime, maybe 25. Interesting point on the gas station piece. We've seen a flurry of activity in the last 3-4 years with gas station corners. And I think we've come to, I wouldn't say we've come to a slowdown point, maybe is the best way to put it, is that I don't think we're going to see as much activity there as we have in the past, predominantly because pretty much all the corners are taken. But there's still opportunity out there, but just not as much. And so that's one sector of the market we're going to see probably a little slowdown in.
Coby, you want to put a bow on this? What growth area in the industrial?
Yeah, on the industrial side, really it's going to, ground zero is going to be our airport area out there off 7th Standard and 99. There's multiple industrial parks that are going right now or that are planned. So a lot of the growth, there's several hundred acres out there right now that we're moving on. And then on the larger side, we're going to have a lot of growth at what's called the Paramount Logistics Park, which is, about 6 miles to the west of our airport area, where Paramount is developing a larger industrial project. We just leased their 1 million square footer, their third spec building of 1 million square feet out there was just leased. And they've already announced that they're going to kick off another 1 million square footer out there that is set to be delivered hopefully in 24 at this point. So there's a lot of development growth out there. And then if you go south in a kind of a competing market for those large projects is going to be the Tejon Ranch Commerce Center. They have leases out for signature, my understanding, for the 651,000 footer they spec down there. So as we start seeing these larger tenants starting to come into our market and leave the LA basin for a multitude of reasons, we're going to see a lot of growth in those two areas because that's where the developable land is. And that's really what the problem is for industrial. It just takes so long to get something developed. If you have land that's already passed all the requirements and you can build, then it's just a construction project at that point. So those are really the areas that are going to have a lot of growth over the next 5-10 years.
Great. Well, I got one question that's in the chat, and it's a question I had on my pre-question list, and I think we'll end with this one. So I think this is something someone specifically wants to know the answer to. So this is in the area of leasing. What are you, Matt, seeing so far as how long are lease terms out in the office market?
Really depends on the size. So smaller tenant leases tend to be, well, I'll start by saying most landlords are targeting a 3-year term. If a space can be leased primarily as is, some landlords on small leases will consider something shorter, but call it plus or minus 3 years for somebody that's 1,000, 2,000, 2,500 square feet. Moving up from there into the 2,500 to 5,000 plus square foot range, you're typically in the 5-year range. Sometimes it's a little shorter. Again, it depends on the amount of tenant improvements required for a tenant to get into occupancy. Larger tenants than that tend to be a little longer term, 7 to 10 years. And then generally we don't see anything longer than 10 years unless it's a build-to-suit lease transaction.
Matt, what are we seeing price ranges? How much a foot?
And I'll quote it on a monthly basis, but it varies considerably. The predominant type of lease in the office world here in Bakersfield is a modified gross lease, except for newer construction and the newer western parts of town are leased under a triple net lease. So just to make sure we're talking apples to apples, under a gross lease in older second, third, fourth generation space, I see rents ranging from typically about $1.50 a square foot modified gross to $1.85, $1.90. In the nicer areas of town, they're typically ranging from $2.10 per square foot modified gross up to the equivalent of about $2.75 a square foot modified gross. Note that those are on a triple net basis, but I'm grossing them up for you.
Okay, perfect. Coby, lease
generally you're going to have, we try and always at least get a 3-year minimum term. If it's anything with, generally all the deals we do are 4,000 feet plus. So 3 to 5 years is pretty typical. Some of the larger developments are going to be up, 5 to 10 year terms on that. If you get into, 20, 40, 50,000 feet. In terms of ranges, it depends on the product type. Obviously we go, 1,000 feet to 1 million feet. So there's a lot of range there, but just general the majority of our market is, 5 to 20,000 feet. And if you're, outside of the southeast part of town, you're going to be looking at $1 a square foot industrial gross plus.
Anthony.
So Keith, on the retail side, if it's second gen space, smaller, generally it's going to be a 3 to 5 year, kind of similar to both Coby and Matt's comment. Rental rates are going to be the $1.50 to $2.25 a square foot triple net, depending on the location, depending on co-tenancy. And then there's a big jump up to if it's new space, you'll probably see rental rates being quoted in the $3.50 to the low $4 range, depending on where it is in co-tenancy. And if there's a drive-through component, rents could be up over $5 a square foot for space with the drive-through. So that's the range that we're seeing right now. And those leases that would be new space terms anywhere between 5 to 10 years, build-to-suit basis anywhere between 10 to 20 years. And a build-to-suit's really cost per foot is really predicated on the cost of the development and return to the developer investor. So hard to say exactly, but those are the metrics that we'll use to calculate rent.
Gentlemen, thank you. Those that are out there listening to this webinar and will listen to it on a recorded basis, what you got was information from 3 experts. If you learn anything, if you're looking at commercial real estate, whether it's industrial, whether it's office, whether it's retail, or anything, seek out a professional, seek out these kind of folks that have the background, the experience, and could lead you in the right direction. So I want to thank you guys again. I think we went about 5 minutes over. I had 5 more questions. We could have easily gone another 45 minutes, but want to be respectful of your time and our viewers out there. With that, thanks sponsors as always. Next week is webinar number 252. And this one's the future of retail. That's interesting. So I don't know if they're going to talk pop-ups, brick and mortar, I'm not sure, but Kelly will be back. The guest is Lanny Lott. She's the president of LL Consulting. So with that, everybody enjoy your week and thank you for participating.